Hello and welcome to Moneylife News and Views. I am Debashis Basu. At the end of July, I had written an article which was titled An Old New Bull Market, which tried to explain the market mood against the backdrop of rising inflation, escalating interest rates and slow growth, which all of these three factors normally together act as a wet, cold blanket for the stock market. But the stock markets were resilient despite these three factors. The S&P 500, which is a US market index, the bellwether, was down only 14% till July when I wrote the article. Second, it is well known that when the US sneezes, emerging markets catch a cold. But as I remarked then, Indian markets were even stronger than the US markets. So it was very clear that there was something else happening in the stock market. The markets were supposed to go down, they were not going down. So what has happened since then? So it's now August, September, October. So it's 3 months now, right? Things have worsened. Since July, the US Federal Reserve has hiked benchmark rates by 75 basis points twice. In March, that rate was just 0.25%. The rate is now 3.75%, an unprecedented and ferocious surge in a very short period. Now, this, as I said, should have led to a big problem for the stock market. This is a massive headwind, as everybody recognizes. The US market has taken this blow on the chin, but as a whole, not declined. After a sharp fall in September, it rose again in October, and remarkably enough, it is at the same level as it was in June end, despite 375 basis point hikes in July, September, and November. In fact, if anyone had asked even a seasoned market professional to predict what the index would be after a 225 basis points hike, they would have predicted a mini crash. Indeed, there is a possibility of an infinite number of further hikes, as the Fed chairman asserted last week. But what about also the second assumption, which is that when the US sneezes, emerging markets catch a cold? Unbelievable it may seem, the Nifty has hit a new lifetime high on monthly closing basis. Yes, and appears to be headed higher. This sort of thing usually happens in a continuing bull market. But stock prices, the ultimate arbiter of all these debates, seem decisive in their verdict so far. We could perhaps call it a stealth bull market because nobody seems to be noticing it, nobody seems to be being euphoric about it, nobody seems to be celebrating it. The question is, why are the markets heading higher when the world seems to be in such a bad shape? Many argue that this is a bear market rally. So a counter trend move during an ongoing decline, since the market never really declines in a straight line. This lot believes that investors who are buying today and pushing prices higher are foolish and don't know what they're doing. They say it's illogical to assume that high interest rates will not negatively impact business. A slowdown is inevitable since the US Fed has been talking tough and won't stop raising rates until inflation is tamed. Consequently, a business slowdown is inevitable, which would lead to eventually massive sell-offs and stock prices follow earnings over the medium term. Now, the impact of rising rates and geopolitical trends is visible in US, Europe, and some Asian countries, but is India as vulnerable? It is different this time. The four most dangerous words in investing, according to Sir John Templeton, a very wise and successful investor. But some things indeed are different. With the benefit of hindsight, India's stealth bull market is underpinned by some strong positives. The most important of these is earnings growth across different sectors. For example, travel, which has a strong multiplier effect, is booming. Among the biggest gainers through the turbulent market of last year is Indian hotels, which is up 100%. The stock price is up 100%, even though the market has not gone anywhere. Sales of cars, bikes, jewelry, watches, and high-end garments are strong. This is why among the biggest gainers are Mahindra & Mahindra, up 51%, TVS Motors up 68%, Eicher Motors up 48%, and Raymond up 183%, and so on. The second important factor is continuous and rising offtake of engineering and capital goods. This is something that we are witnessing after a decade or so of stagnation. This is driven by investments across railways, roads, defense, and manufacturing sector. Not surprisingly, among the biggest gainers of last year were Elecon Engineering 132%, Schaeffler, which makes bearings, up 95%, CG Power Solutions up 73%, Timken 53%, and Tube Investments 48%, and so on. The third major trend has been a sharp and growing interest in defense sector, thanks to a major policy shift to increase local procurement as well as to increase exports. This is reflected in the stocks of Mazgaon Stock Dockyard up to 203%, Garden Reach Shipbuilders up 132%, Hindustan Aeronautics 96%, Cochin Shipyard 73%, Bharat Electronics up 88%, among others. Finally, the fourth major driver of the Indian market has been the strong credit cycle, which has benefited small private banks, non-banking finance companies, along with the cleanup that has happened in the public sector. The public sector stocks are also rallying very sharply. Over the long term, stocks are slaves to profit growth. But over short to medium term, stock markets react strongly to surprises and also to stories and narratives of expected profit. Because the entire market was bearish, all of these positive trends has come as a major surprise to the market. And as well as the fact that some of these sectors offer tremendous opportunities of future growth. Whether it will happen or not, we'll have to see. But the narrative is very, very strong and expectations are very strong, which ultimately drives stock prices. We are witnessing a combination of all of these factors, and there are many stocks with strong earnings growth and stocks where expected earnings growth are likely to be high. This is why we have a stealth bull market, even as the macroeconomic picture looks pretty uninspiring to many. Thanks for watching this, and if you liked it, please do subscribe and share. Thank you.